So, when you buy a stock, what's the game plan? Usually, you're just waiting for the price to go up, right? That classic buy low, sell high play. But what if I told you that's only like half the story? What if your stocks could actually be working for you, generating a real income stream while you're just waiting? Okay, let's get into this.
Seriously, think about your own portfolio for a second. For a lot of us, those shares are kind of just static lines on a screen. I mean, sure, they represent value, but they aren't actively paying you anything. They're just sitting there.
And that's the big idea we're going to dig into. We're going to look at three completely different ways to turn those static assets into active, income-generating parts of your portfolio. Let's start with the one you've probably heard of. Okay, so the most common way a company shares its profits is through dividends. But what if that simple dividend payout could be put to work on its own, automatically, creating this powerful growth engine for your investment? Let's see how that works. A dividend is pretty much the most direct way a stock can pay you. It's basically the company saying, hey, thanks for being an owner, here's your piece of the profits. It's cash and it lands right in your brokerage account. But you don't have to just let it sit there. And this is where the magic of automation comes in. A DRIP, that's a dividend reinvestment plan, is a super simple set it and forget it tool that most brokers offer. Instead of that cash dividend just hanging out in your account, the program automatically swoops in and uses it to buy more shares of that exact same stock. And this creates what's called the compounding snowball effect. It's brilliant. You earn a dividend, which buys more shares. Now, because you own more shares, your next dividend payment is even bigger, which then buys even more shares. You see where this is going? Over time, this thing can seriously accelerate your growth, and you literally don't have to do a thing. All right, let's switch gears to a more active strategy. Now, I know the second I mention the word options, some people get a little nervous. They think it's all about high-risk, complicated stuff. But that's really not the whole picture. And hey, don't just take my word for it. This quote calls this strategy conservative. So why? Well, because you're not just wildly speculating. You're actually generating income from stocks you already own. You're using them as the foundation. So here's the deal. In plain English, you own, let's say, 100 shares of a stock. You agree to sell those shares at a specific, higher price if the stock hits that price by a certain date. Just for making that agreement, someone pays you a fee. It's called a premium. Right now, today. And that cash, it's yours to keep no matter what happens next. So this whole thing leads to two potential win scenarios. Okay, scenario one, the stock price doesn't hit your target price. That's great. The deal just expires, you keep your original shares, and you keep the cash premium you were paid. You can then just do it all over again. Now, scenario two, the stock price does hit the target. Also great. You sell your shares at that higher price for a nice profit, and you still get to keep that extra cash premium you were paid up front. The main risk, of course, is if the stock totally skyrockets way past your sale price, you'd miss out on those extra gains. Now check this out. And I have to say, this is an exceptional example to show the potential. This is definitely not a typical result. A NASDAQ analysis highlighted a series of trades that generated an annualized return of over 200%. This just shows the power of consistently collecting those premiums. But it's really important to remember, a return like this is super unusual and totally depends on very specific market conditions. Okay, on to our third strategy. And honestly, this is one that a lot of everyday investors don't even know is a thing. You can actually get paid just for owning certain stocks by lending them out. It's called securities lending. Now, you might be wondering, why on earth would someone pay to borrow my stock? Well, a lot of the time it's for short selling. They're betting the price will go down. But for you, the process is dead simple. Your broker handles everything, loaning out your shares, and in return, you get a cut of the lending fee, paid to you as daily income. And this is actually what it looks like. This is a real statement showing what it's like to have securities on loan. You can see the stocks listed, and right next to them, there's a current interest rate. That rate is what determines your daily earnings, which you can see adding up in that last column. I mean, in this example, it's over $10,000 in a single month, just from those lending fees. Okay, so all of these strategies sound pretty great, right? But here's the deal. Generating income always involves trade-offs and risks. So we absolutely have to look at the fine print. Let's just ask the question that's on everyone's mind. If you can earn extra money this easily, what are the downsides? What do you need to look out for? So brokers do build in some protections that give you collateral, usually cash, to cover the value of the loan.
and you still technically own the shares, so you can sell them whenever you want. But, and this is the big one, the most critical point here, loan shares are not covered by SIPC insurance. That's the program that protects your assets if your brokerage firm goes belly up. Losing that protection is a pretty significant risk you have to be comfortable with.
And it's not just something to think about. European regulators have actually weighed in on this, pointing out these exact risks. They really stress that you, the client, should be the one who benefits from all that revenue. And they warn that firms need your express consent. It can't just be some clause buried on page 47 of a document you clicked agree on. And this quote from the European Securities and Markets Authority really gets right to the heart of it. They're basically saying that if a firm is making money by lending out your assets and you're not really seeing the benefit, then that firm might not be acting in your best interest. The money, they argue, should be flowing to you.
And finally, we've got to talk about taxes, because not all this income is treated the same by the taxman. While some dividends might get a lower qualified tax rate, those lending fees are almost always taxed as regular income. And there's another little detail. If a dividend gets paid while your stock is out on loan, the borrower has to pay you an equivalent amount. They call this a manufactured dividend, and yep, it's also typically taxed as regular income, which could mean a higher tax bill for you. So, wow, we've covered a lot of ground here, right? 3 totally different strategies, each with its own good and bad points. Let's just put them all side by side to make it super clear. This table really lays it all out. On one end of the spectrum, you've got drips. Low complexity, low risk, and completely passive. The biggest risk there is just putting more of your eggs in one basket. Then you have covered calls, a bit more active, medium risk, because you could be capping your own potential profit. And securities lending is the interesting one. It's super passive to get going, but because you lose that SIPC insurance we talked about, its risk level is definitely in that medium category. And that really brings us to the final and most important question. It's not about which of these strategies is the best. It's about which one, if any, is right for you. Your stocks don't have to just sit there. But if you want to turn them into income generators, you have to understand these trade-offs and decide for yourself just how much risk you're willing to take on for that extra reward.